we want to look at problems from chapter 2. So let's look at the first one. The first problem requires you to look into the balance sheet of this company Global, which is in your textbook. So if you go to your textbook and look at page 29, it gives you the balance sheet for this company Global, and it asks the question, which line items would be affected and by how much? And the first scenario, they say if Global used 20 million of its available cash to repay 20 million of its 20 million of its current debt. So if you look at cash for 2012, which year are we looking at? For 2013. So 2013, Global had a cash of 23.2. You can see this under cash. So you see this. So you see this 23.2, that's what we have as cash, and long-term debt is 113.2. So if I draw down 20 million of the cash to reduce 20 million of the long-term debt, I will affect both the left-hand side and the right-hand side of the balance sheet, which means that the book value of my equity will remain unchanged. The book value of my equity will remain unchanged. Okay. The next one is inventory would decrease by, what would happen if a warehouse fire destroyed $5 million worth of uninsured inventory? So what would happen? Inventory would decrease by 5 million. And if inventory decreases, it only decreases the left-hand side of the balance sheet. Everything else over here remains the same. Thus, the stockholder equity part will be affected. Stockholder equity will be impacted by the change in equity. So that means by decreasing inventory by 5 million, I will also decrease stockholder book value of equity by also 5 million. Part C, Global used 5 million in cash and 5 million in long-term debt to purchase $10 million worth of building. So that means long-term assets will increase. This part over here, long-term assets will increase by 10 million, but cash would decrease. Cash would decrease by 5 million. Cash would decrease by 5 million, and long-term liability will increase because I am adding $5 million worth of new debt. So long-term liability will increase by $5 million, but there will be no change in book value of equity because the net change on this side would be 5. And the net change on that side would also be 5. So there will be no change in the overall book value of equity. Part D, a large customer owning $3 million of product already received declared bankruptcy, leaving no possibility that Global will ever receive this payment. That means accounts receivable will now decrease. You're 18.5 in accounts receivable, that will decrease because you're not going to receive that payment anymore. So 3 million decrease in accounts receivable would also leave book value of equity down by 3 million. And parts E and F will have no effect on balance sheet. Okay. So this is just a brief overview of how different transactions that the company does on a day-to-day basis may affect changes in the balance sheet. The next problem I want to look at is this one over here. It requires you to go and pull up the report, the 10K annual report for GMCR, and then answer the questions given over here. So where do you find GMCR's annual report? You will find it under sec.gov. You can just Google GMCR 2012 annual report, and the first hit that you get is this one over here. This is SEC's, where GMCR has to file its annual report, and we're looking at the 2012 numbers, as you can see over here. And we can look at, here is the balance sheet. We can scroll, of course I have to get everything into one page over here. I can scroll down and up and look at income statement and so on and so forth. So the first part of the problem said, for question number 8, the first question was, what were Green Mountain's revenue in 2012, and by what percentage did it grow from 2011? So where do we find revenue? To find revenue, we have to go to the income statement. So Green Mountain's revenues increased from 2011, which is 2650899 to 3859198. So what is the percentage change in the revenue then? Percentage change in revenue, we can calculate this, would be the ending revenue, that means 2012's ending revenue, which is 3859.2 minus the beginning revenue last year, which is the beginning point, which is last year's revenue, which is 2650.19 divided by the beginning. End minus beginning divided by beginning. That's the formula we are using. And that gives us an increase in revenue of 45.58%. That's by how much the revenue increased. The next question is, what were operating margin and net profit margin for 2012, and how do they compare with 2011? So what are the formulas for operating margin and net profit margin? So if you go back to your book and look through the financial ratios that we had studied in class, you will find on page 41 operating margin and operating margin and net profit margin. So operating margin is operating income divided by sales. Operating income divided by sales. And net profit margin is net income divided by sales. Net profit margin is net income divided by sales. So now we have to go back to our balance sheet over here, to our income statement, and find out where operating income is. Operating income is right here. You can see operating income, we said net sales, cost of goods sales. We take out other expenses, administrative expenses, other operating expenses, and what is left is operating income. So operating income for 2012 was 568.89 or 568.9, and net sales for 2012. Net sales for 2012 was 3,859.2. So we take this number, divide that by that number. So operating margin for 2012 is 568.9 divided by 3859.2. So operating margin is, for 2012, 14.74. What is net profit margin? Net profit margin is going to be net income. So we go back to the balance sheet again, and look at where net income is. Net income is here. Okay, net income attributable to GMCR. So we again start with cost of goods sold, we get selling expenses, operating income, then we get all of that, subtract interest expense, we get EBIT, earnings before interest and taxes, we pay tax expenses, we add other net income from other sources, and this one, net income attributable to GMCR, that's the number we are looking for, which is 362.62. So net income is 362.62, and we will divide that by sales, which is 859.2, or sorry, 3859.2, which gives us a net profit margin in 2012 of 9.40%. 9.40%. So that's our operating profit margin, that's our net profit margin. Similarly, you could do this for 2011, and then you can figure out the change. Part C of that question, in question number 8, Part C asked, what were diluted earnings per share in 2012, and what number of shares is this based on? So we're looking at diluted earnings per share, and we will find out that the diluted earnings per share is over here. So diluted earnings per share, right over here it says, net income per common share diluted, that's 2.28. So 2.28 is based on using diluted weighted average shares outstanding, and what they have used is 159.075. So without dilution, it was 2.34. With dilution, number of shares outstanding goes up to 159. That includes other shares that may not be available to common. All of that has to be included when we calculate the diluted earnings per share. So diluted earnings per share is 2.28. So that's going to be 2.28. And what number of shares is this based on? We just read from the balance sheet, it was our income statement, it was 159.08 million shares to calculate the diluted earnings per share. Again, this is just getting to understand how to read these financial statements. Based on the same report, how much cash did Green Mountain generate from operating activities in 2012? So we're looking at question number 15 now, but using the same GMCR report. So net cash by operating activities in 2012. Where do we find that? Where do we find out net cash from operating activities? To do that, we have to go into the consolidated statements of cash flow. Okay. So in 2012, net cash from operating activities, you can see this, how it is calculated. These are the items that go into it. We start with net income, make all of these adjustments to net income, and we come over here, net cash from operating activities. Hold on. Okay, net cash provided, used for operating activities is 477.785. Okay. Then the question number, part B was, what was depreciation expense in 2012? To find depreciation expense, I have to go back up to my income statement. So we look at there are several ways in which we can find out depreciation expenses. Over here, we can come up over here. It should be somewhere here. Can't find it now. Income, subsidiary expenses. Okay, so we can. I'm going to skip that part B for a moment. I'm trying to look for it. But let's go to part C. What was the net? Part C asked the question: what was the cash invested in new property in 2000? In new plant and property in 2012. So we look at essentially that the net cash used in property in 2012. We'll look at the number for long-term assets. So we have to take the difference between two numbers. So we will look at fixed assets net 944,296, and look at the change in 2012 from 2011, and the difference between that will give us how much did we add in new plant and property, new plant and property. So that's the number we will be looking at, the change in those numbers, and so on and so forth. So essentially, just wanted to share with you a original look into a balance sheet and income statement, and how to read the numbers from here to transcribe them into the variables that variables that are of interest to us. One more time, I want to look at the depreciation part of it. Where is depreciation noted over here? Here is depreciation. Depreciation over here is 135.66. And again, in the statement of cash flow, I can find depreciation of 135.66. So okay, so that gives me that information. All right, so that's problem number 15. Let's go back over here and let's take another problem. Over here, we're looking at a company, Starbucks, with revenue information given to us. What else is given to us? We have information about revenue, gross profit, net income, and we have another company with the same information, and the question asks, compare the gross margin of the two companies. Gross margin, as we just learned, is gross profit divided by revenue or sales. Gross margin would be gross profit divided by revenue or sales. So gross profit for Starbucks is 6.75 and revenue 11.70. So 6.75 divided by 11.70, that gives us 57.69. That's for Starbucks, and for Pete we can do the same thing. Pete's gross profit is 72.79, and at a revenue of 372. So we can do that, and that gives us 19.54. Then we can find out net profit margin. Net profit margin is going to be net income. So we take net income of 1.25 and divide that by revenue of 11.70. Make sure that all your units are matched up. Since over here everything is in billion, so we can write them directly. If revenue is in billion and net income is in million, then make sure that you write them, represent them appropriately. So net profit margin is going to be 10.68 for Starbucks. And similarly, you can calculate that for Pete's Coffee. So which company is more profitable? Well, one way to look at more profitable is looking at both net profit margin as well as gross profit margin, and by both accounts, Starbucks was more profitable in 2011. Question number 26. Calculate interest coverage. Interest coverage is going to be, what do we have? We have interest expense. We have an interest expense of 1 million and an operating profit margin of 10% on total sales of 30 million. So using that number, the first thing we have to calculate is calculate operating income. And so operating, if you remember, operating margin is operating income divided by total sales. So operating margin is operating income divided by sales. So I have operating income is simply going to be sales multiplied by operating margin. Sales is 30 million and operating profit margin is 10%. So that's going to be 3 million. Okay. Then we take that 3 million, that's our operating income. We divide interest expense into it. So interest coverage ratio is going to be operating income divided by interest expense. So we have 3 million divided by 1 million, which is 3. It essentially tells us that we have 3 times coverage to meet our interest obligations. Because interest, as you recall, will be paid from our operating income. Whatever we have left in operating income, we will use it to pay the interest payment. And right now we have 3 times coverage in our operating income to meet our interest obligations. Question number 27. You have net profit margin is given, sales is given, book value is given. So we have net profit margin, sales, book value, and total liabilities. What is ROE and ROA? Okay, so let me go to the sheet over here and add a page. Okay, so I can do this problem on the next page. ROE, what is the definition of ROE? ROE is net income divided by equity. So what is net income going to be? Net income from the information that is presented to us. And this is where we have to be looking very carefully. We have net profit margin and we have sales. If you recall what net profit margin, the definition of net profit margin is net income over sales. So net income is going to be sales times net profit margin. So sales is given as 50 and net profit margin is 5. So sales is 50 million and net profit margin is 5%. So from this we get net income as 2.5 million. Once I have this, then I can substitute this into the formula for ROE, and ROE is going to be 2.5 million divided by equity, and equity is given as 40 million. That gives me a ROE of 6.25%. 6.25%, that gives me my ROE. Similarly, I can do ROA, return on assets, is what? Is net income over assets. What information do we have for assets there? We have liability is 30 and equity is 40. Okay, so what's asset? Asset is liability plus equity. Total asset is liability plus equity. So liability is 30, equity is 40, so total asset is 70 million. So now all we have to do is net income. We already have this as 2.5 million. Divide that by the asset of 70 million, which will give us 3.57%. Okay. So this question number 34. Asks us to use the DuPont identity. If you remember in the DuPont identity, return on equity equals net profit margin times total asset turnover times total assets to equity. So we have net profit margin is already given to us 3.5%. Total asset turnover is 1.8. Total asset is 44 million and equity is 18 million. So we just put all those variables into the formula and that gives us an ROE of 15.4%. So if the firm increases its profit margin, if the firm increases this number, obviously this number will also go up. If the firm increases its revenue, what would its ROE be? If the firm increases its revenue, that will also increase its that will also increase its ROE because total asset turnover would increase. Total asset turnover is revenue over assets. So if revenue increases, then total asset turnover increases, and that will also increase ROE. So with that, it concludes the problem tutorial for Chapter 2.